Hey, everybody.
How you doing?
All right. How's everyone?
Doing okay.
It's a Friday, right? Long weekend? Number 6, Chapter 9. If the bank you own has no excess reserves and a sound customer comes in asking for a loan, should you automatically turn the customer down, explaining that you don't have any excess reserves to lend out?
You probably shouldn't turn them down automatically because you could always borrow money from somebody else. And if you're going to lend it to them at a higher interest rate, you could still make a profit.
That's exactly right, Matt. Thank you very much. I appreciate you participating in class today. What about someone else with a different idea?
If they don't have excess reserves, that doesn't mean it's a shortfall, right?
Well, I'm not sure I understand the question.
Like in the PowerPoint, it says that excess reserves are insurance against costs associated with deposit outflows. And that was under the shortfall slide. What exactly is a shortfall? Is that when you don't have excess reserves?
Yeah, that's exactly right. So they don't have excess reserves. So the customer wants to take a loan. So if they give them the loan, they're going to have a shortfall in their reserves. And they have to cover that shortfall. Is that your question, Ryan?
Yeah.
Yeah, they'll have to cover the shortfall if they give that customer the loan. They will have, as Matt said, to go and either borrow it from another bank, borrow it from the Fed, sell some of their own securities, or call in a loan from another one of their customers, right? Those were the 4 things that we said they could do to cover a shortfall. But I'm interested in another aspect of telling the customer to piss off, basically. Anybody?
Maybe if their credit isn't good, they would be like, okay, we can't loan them the money. But if it was somebody that is like assured to like pay back over time, maybe that would be a reason.
Yeah, okay. So it would be better. They might be more likely to give the customer a loan if they were a good customer.
Yeah.
Is what you're saying, Brooklyn? Somebody else. What else is going to happen here?
Well, if you tell the customer like that you can't lend them money and they're a sound customer, then they're probably never going to come back to you for business ever again.
Yeah, thank you very much, Sean. They're going to be pissed off, aren't they? And they're going to tell their students in their money and banking class never to go to that bank because that's the kind of person they are. Yeah. So those are all very good options. Number 11, what are the benefits and costs for a bank when it decides to increase the amount of its bank capital? I want to see you all. There we go. Look at all these smiling faces.
Could lend more money to more people.
Well, this is the
Increase.
bank capital, the owner's equity, right? They're not going to loan that out.
They well, since they have a higher bank capital, they're less likely to go broke if something were to go wrong.
Ah, that's a good idea. Yeah. So if they have a bank capital and something goes wrong, like a loan defaults, then they have the resources to stay in business, don't they? But what's a downside to this?
They're not lending the money, so they're not getting as much money in return because they can't loan as much because they don't have as much because they're holding on to more capital.
Yeah, okay. Their equity multiplier is less, right? So
Yeah.
the return on equity in the bank will be less. So there's a trade-off about the benefits of hanging on to capital or the increased return on equity. Yeah. So we did that little example in the text about the return on equity for a bank that has a lot of capital and the return on equity for a bank that doesn't have much capital. So we would rather be involved in an investment that's returning 15%. But if that 15% comes at the cost of potentially going out of business, that's not so good. Maybe we'd rather get a return on equity of 5% and stay in business longer. All right, very good. Everybody done very good. Thank you. Let's look at these last three. So 19, 21, and 22. I'm going to put you, there's three. I'm going to put you into three groups. And you do 19, 21, and 22. Group number 1 does 19, group number 2 does 21, and group number 3 does 22. Pick a spokesperson so that when we come back, you can tell us all about it. All right, let me stop and bring you back. So I'm sorry. I was trying to do something. I want to figure out how to Sorry.
Professor Gallagher.
Hi, Nolan.
Hi. Well, I think kicked me off again. I was in group 1. I don't.
I'm gonna bring everybody back anyway.
Sounds good.
Okay, did you all enjoy your trip? Who's gonna talk about number 19?
Me. Okay. So, just reading the question, using the T counts of First National Bank and the Second National Bank given in this chapter, describe what happens when Jane Brown writes a $50 check on her account at the First National Bank to pay her friend Joe Green, who in turn deposits the check in his account at Second National Bank. So at First National Bank, their liabilities would go down by 50 because she withdrew the money. And then at Second National Bank, when he deposits the check, their checkable deposits increases by 50 and their liabilities increase by 50.
Yeah, that's exactly right. Although there's more that happens.
With the reserves, right?
Yeah, on both of them.
Yeah, so the reserves would go down at First National Bank and they would go up at Second National Bank.
That's exactly right. You can't do something to one side of the balance sheet without doing something to the other side of the balance sheet, right?
Yeah.
So at the First National Bank, liabilities and assets would go down by $50 because they're taking money out of their checking account and the reserves at the bank are going down. And the reverse is happening at the other bank. Thank you, Paige. Great. The next one, what was the next one?
Next one was 21.
Angus Bank, how about that?
For that, we took 300 million, subtracted the 5 million outflow, and also with the 27 million, subtract the 5 from outflow. And we got 22 minus the 295 times the 9%, which we came up with negative 4.55 million, and times that by the 25%. And it came up with an answer of 11,375,000.
Thank you, Nick.
Okay.
Ooh, there's an echo. Ooh, there's an echo. Anybody get anything different?
We meant 11,375 because it's 0.25. I think we just misread it.
Oh. Is that true, Nick?
Yeah.
So it's not 0.25, it's 0.0025, right? Because it's 0.25%. So you have to multiply it by 0.0025. Okay, excellent. Great job, Nick and Tyler. Thank you. What's the last one?
So for this one, it wants to know what the cost of the insurance policy is, which is the 12 million in excess reserves. So we thought it would be the 3.5%, which is how much they could be earning if they didn't have that in reserves, plus the 0.2%, which is the cost of the interest paid on reserves, multiplied by the 12 million, which is 444,000.
So what's the actual cost?
444,000.
Oh. Anybody get anything else?
Is
Would
it-
you subtract the 0.2% from the 3.5% and get
Yeah.
396,000?
What?
Would you subtract the 0.2% from the 3.5% and then multiply it by 12 million and get 396,000?
Yeah, that's what I would do. But first of all, you're getting 0.0035. 0.035 on $12 million, right? 0.035 times 12 million is $420,000. That's the interest that they lose, right? And then that's the interest that they lose, but they're collecting 0.02, 0.2%, right? So
I thought they were losing it. That's why I added them. I didn't realize like
well, they're losing the being able to loan out the 12 million, but they're collecting the 2%. So nowadays, and it didn't always be true, it wasn't always true, but nowadays the Fed pays interest on excess reserves. So they're being paid 2%, 0.2%. So $396,000 they're losing. Did somebody say that?
Yeah, I did.
Yeah, Jack. Because they're able to collect that 0.2%, which is a very small amount, but it offsets what they're losing for the 12 million that they're not actually loaning out at 3.5%. Yeah? Is that cool for everybody? Okay. Now, this chapter has number 24 and number 25. I feel like I want you to do those two because it's a crux of the chapter. Hang on, let me. So I want you guys to do number 24 and number 25 over the weekend. I don't want to collect it though. Okay. I don't want to look at it and grade it and all this other crap, but I want you guys to know how to do it. So when you come in on Monday, we're going to talk about it. All right. 24 and 25. They don't look very hard, but you should know and understand gap and duration. Okay. Is that fair? All right. Because I want to move on, I want to talk about chapter 10. Anybody have questions on chapter 9? Let's start talking about chapter 10. We only got a few minutes. So it's very bright in here and I can't see my screen. It's kind of not a good thing. Chapter 10, Economic Analysis of Regulation. Regulation is very high in our financial system. Unfortunately, it's not always very effective given our 2008 financial crisis, right? So we want to talk about the reasons for and the different forms of a government safety net in the financial markets. And then we want to talk about the kinds of financial regulation and how each reduces asymmetric information. So why do we need a government safety net? And what kinds of government safety nets are there? Yeah. Asymmetrical information as a rationale for financial regulation. So we have bank panics and the need for deposit insurance. The FDIC, Federal Deposit Insurance Corp, short circuits bank failures and the contagion effect, payoff method. There's also the purchase and assumption method, other forms of a government safety net. So the FDIC was formed in 1934. Prior to 1930, bank panics were a way of life. Every 20 years or so, we had a major panic. And in the 20s, during the Great Depression, there were 600 bank failures a year. So that's like holy smoke, right? So the FDIC was formed. This is a safety net. Back then, I think they guaranteed you up to $10,000. They insured you. Now it's up to $250,000. The FDIC will pay off depositors up to $250,000, and then, of course, the depositors would have to line up with all the other creditors. Typically, using this method, a depositor will get back 90 cents on the dollar over 250,000. So this is a pretty good scheme. Yeah. The federal government insures your deposits at the bank up to $250,000. So I always got to talk about the movie, It's a Wonderful Life. You've all seen the movie, It's a Wonderful Life. Am I right? No? Paige, where did you grow up?
In Buffalo.
And you've never seen the movie It's a Wonderful Life?
No, I haven't. It comes on at Christmas, doesn't it?
Yeah.
I'm usually watching Christmas Vacation or Christmas Story.
How many of you have not seen the movie It's a Wonderful Life?
I never heard myself.
Holy Jesus. Man. Oh, that's too bad. Well, I think you should make it a point to watch it over the weekend and write a 15-page essay on what happens.
Do we get A's?
All right, never mind. Don't do it. You don't have to write a 15-page essay. It's a Wonderful Life. It's a really a good what? It's a really good way of explaining what happens when we have a bank panic, you know? So you put all your money at the bank and then you hear that like the bank is going out of business. You want to get your money, right? So everybody in town goes to the bank and says, hey, give me my money back. But of course, the bank doesn't have that kind of money, do they? They only have the reserves that they're required to keep. So they can't give you your money back, right? This is what a bank panic is. All right. Purchase and assumption method, the FDIC finds a merger partner. They did this during the 2008 crisis. They assumed the bank's failed liabilities. Lastly, the lender of last resort is the Federal Reserve Bank, so lending from a central bank to troubled institutions. Has government deposit insurance helped improve the financial system and prevent banking crisis? The answer seems to be no. Research at the World Bank seems to answer no. On average, the adaptation of explicit government deposit insurance associated with less banking sector stability and a higher incidence of banking crisis. Furthermore, deposit insurance seems to retard financial development. We're going to talk more about this in as we go through the rest of this lecture, okay? Government safety nets. So moral hazard, right? We talked some about moral hazard and adverse selection, and here we are talking about these things again. So moral hazard, depositors do not impose the discipline of a marketplace because they're guaranteed $250,000. Financial institutions have an incentive to take on greater risk. If the bank knows that the government is going to bail them out, they're going to go behave more, do more misbehaving, right? Adverse selection. So risk lovers will find some way to get the money. Depositors have little reason to monitor, right? If you know the government's going to guarantee you up to 250 grand at the bank, you have little reason to go to the bank and say, hey, I want to see what kind of investments you're taking, right? So the concept of this insurance provides increased incentive for a bank to take risk. Also, because depositors know the money is guaranteed, they don't have a discipline associated with the marketplace. Adverse selection, risk-loving entrepreneurs are going to find the financial industry attractive. Government says too big to fail. Government provides guarantees of repayment to large uninsured creditors of the largest financial institutions, even if they're not entitled to this, right? The government does not want to see banks fail. So the government is afraid of a big failure. Anything over the 250,000 is going to create a huge panic, right? So they use this purchase and assumption method. In other words, they will merge a bank with a willing partner after a big infusion of capital. So This actually increases moral hazard. A bank will behave in a risky fashion if they know they're too big to fail. So Stuart McKinney, he was from Connecticut, by the way, a congressman, and he was the first to use this term, too big to fail. Financial consolidation in the government safety net. So larger and more complex financial organizations challenge this regulation. Increase the too big to fail problem. Extend safety net to new activities, increasing the incentive for risk taking in these areas. So we have two acts that you guys should be familiar with. The Regal-Neal Interstate Banking and Branching Efficiency Act of 1994. I'll say that again. The Regal-Neal, Reagleneal, Interstate Banking and Branching Efficiency Act of 1994. Then we have the Graham, Leach, Bliley Financial Services Modernization Act of 1999. So Graham, Gramm, Leach, Leach, Bliley, Bliley, Financial Services Modernization Act. These acts have contributed to greater consolidation in the financial industry, leading to bigger and more complex banks. The potential problems are even broader, leading to a wider safety net, which leads to greater moral hazard. Do you see how they all sort of it becomes synergistic? Yes, it rolls along, and it's as it gets bigger and bigger. So, types of financial regulations, restrictions on asset holdings. These are types of things that the government tries to do to eliminate some of the problems. They restrict financial institutions from taking too much risk. Bank regulations mean that they have to promote diversification, so banks have to be diversified. Banks are absolutely not allowed to hold any common stock, right? We do not want a bank to hold any equities. That would be against the rule, and it would be a conflict of interest for the bank. So, and then we require banks to have certain capital requirements, minimum leverage ratio. And then there was the Basel Accord, where they set risk-based capital requirements. But we'll talk more about that. The banks have, we talked about having more or less capital, but we will talk more about how the Basel Accord has said what those requirements should be, right? And then we'll talk about regulatory arbitrage. So the government imposed capital requirements are a way of minimizing moral hazard. Based on the leverage ratio, the amount of capital divided by the bank's assets, a bank's leverage ratio must exceed a certain percentage. This will, if they do not do this, they will trigger restrictions on their activities. So, and then we have risk-based capital requirements. Starting in 1999, the Basel Committee on Banking Supervision released several proposals to reform the original Basel Accord. These efforts have culminated in what bank supervisors refer to as Basel II, which is based on three pillars. Everybody send me a chat saying hello so I can take attendance. Okay. Where did we stop? Basel Accord after the global financial crisis of 2008, we have three pillars. Pillar one, capital requirements for large international banks is more closely aligned to the actual risk these banks take: market risk, credit risk, and operational risk. Pillar two focuses on strengthening the supervisory process, assessing quality of risk management in banking institutions, and evaluating whether they have adequate procedures to determine whether or not they're keeping enough capital. And number three, market discipline through increased disclosure about their credit exposures. Where have they put their money? The amount of reserves and capital, the officials who control the bank, who's in charge, and the effectiveness of the internal system they have to protect themselves from doing bad things. Yeah. So this is all the Basel Accord after 2008. All right. Come back here. Stop. And we're going to stop there for today. Okay. Since it's Friday. And when we come back on Monday, we'll pick up here. But first, we'll talk about those last two problems in Chapter 9 that I want you guys to be very acquainted with. Okay? Everybody have a nice weekend. Don't get in any trouble.
Thank you.
Have a good one.
Thank you.
Thank you.
Good weekend.
Have a good one.
Thank you.
Have a good weekend.
Hey, Professor Gallagher.
Hi.
Hey, I was just wondering if you could, I was
Hang
looking
on.
through.
Let me stop recording.